yields are going to go higher from here, regardless of what the Fed does. And if that is the case and rates do go higher, you're looking at interest rates rising on the biggest debt bubble in all of history. And I mean, add to that what's happening in the markets. There has to be extreme stress throughout the derivatives market. And that's the market that will take everything down. Once derivatives go offside and you start getting players that are in the insolvency or bankruptcy area, then you're worried about counterparty risk. And if that becomes a worry, counterparty risk, then all bets are off. The derivatives complex will come down. And remember, that's over a $2 quadrillion market.
What could set off a collapse of the derivatives market? Could it just be a falling stock market? Is that enough of a wildfire to breach the derivatives market, or what would require that?
I don't think so. Yeah, I don't think it's going to be equities. Interest rates or credit markets certainly could do it. And I've said for quite a long time now that my thought was that there would be a failure to deliver of either gold or silver. And I've always suspected that silver would be first. So if you were to get a failure to deliver, the derivatives market will be completely cracked.
And I mean, isn't that what we're seeing today, at least in the LBMA? Not quite there yet. They're talking about 4 to 8 week delivery time, but I mean, are we getting close to a failure to deliver?
Well, at this point, they're still saying we're going to deliver, but it's going to take us 4 to 8 weeks. Mm-hmm. Once we get to the point where somebody, it doesn't even have to be a big trade. Once somebody doesn't get delivered on, and you've got people lining up behind that somebody or somebody's, once they line up for delivery and there's no metal to deliver, it's completely game over. Because what that does is it breaks the trust entirely in the derivatives arena, and the entire system, whether it be markets, banking, what have you, runs on confidence. And if you break confidence, the system comes down because there's no foundation any longer. The foundation of treasury bonds is where confidence will break. So the confidence itself will end up breaking in the foundation itself. And that's the problem with not having something real that backs or supports the whole system.
With derivatives, I mean, we've used this term derivatives over and over again, but for the people who may not be initiated, what are derivatives exactly?
I think it's safe to say that derivatives are leveraged bets. And these bets are on stocks, they're on bonds, they're on interest rates, they're on foreign currencies. They've gotten so crazy that there's derivatives on the weather. There's basically whatever you could possibly bet on, there are bets being made. And that's the problem, is that it's gotten so prolific. The derivatives market is many multiples of what all the assets on the planet are worth. So you have this humongous tail wagging, if you want to call it a bloated dog. And when I say bloated, I'm talking about bloated from the standpoint of credit, too much debt. So that, I mean, that's the danger, is that the derivatives, the dog's tail itself fails. And when that fails, then, the animal itself dies, because you'll have a daisy chain of financial institutions failing.
Right. From what you're seeing from the newly appointed Trump administration, are they doing what needs to be done to quell any potential crisis, or are they just too little too late? They've been able, they started off this trade war between effectively pretty much just China now. Pretty much everyone else has gotten a reprieve of 90 days. but they did slap on an additional 10% that wasn't there before. But nonetheless, the trade war seems to be strictly pretty much a China-focused arena. And then you also have Doge, which its objective was to cut $2 trillion, which is then revised down to $1 trillion. And now the most recent revision has it down to $150 billion, which is still a pretty big amount. But in the context of things, it's nothing more than a rounding error when it comes to not just the national debt, but also the yearly deficit. So are we on the right track to correct course, or is it just too little too late at this point?
Well, yeah, the short answer is yes, too little too late, especially too late, because this has been building up for 40, 50 years. I mean, you could go back, you could really say that this goes back to August 15th of 1971 when we went off the gold standard. And that allowed basically the Treasury to borrow unlimited amounts of credit and then lever that. I view what they're doing as it makes sense. However, what they're doing is going to cause the collapse itself. I mean, you can't take hundreds of billions or $1 trillion out of the system that would have been spent and would have been, would have worked like engine oil, if you will. Mm-hmm. You can't crank the cash flow being generated out of the system. You can't crank that down. And that's what they're doing by no longer, funding a lot of these agencies, Doge coming in, cutting here, cutting there. I mean, that's money that would have been in GDP, and now it's no longer in GDP. So that's less money.
You're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
On the streets. I mean, we've gotten to a point of, if you want to call it debt saturation, and I use that term not just from a government standpoint, but from a corporate and individual standpoint, there's tons and tons of debt outstanding. The way to look at the federal debt, this year we're going to pay $1.5 trillion in interest alone. Wow. I mean, that's $1.5 trillion. I mean, that's a pretty big nut to crack, considering the government takes in what, 4.7 trillion or thereabouts. So it's roughly 30% of the tax base. So we're getting to the point where kicking the can down the road, there's a wall at the end of this road.
Yeah, and the number being floated around for these tariffs is about $400 to $500 billion annually that they anticipate collecting from here on out. But from the perspective that you've just laid out, I mean, that still wouldn't be enough to cover the interest expense on the debt. So even if you do bring in this ERS, this external revenue service that they've been talking about, it still is not enough. It's this recurring theme of, this may have been a great idea about 10 years ago, 15 years ago, but today seems to be a little too late.
It's more than 15 years ago. I mean, 17 years ago was 2008, the great financial crisis. And really something needed to be done before that. And what the response to 2008 was to paper it over with more credit, more debt and more money supply. So what they're trying to do now needed to be done before 2008. And what happened in 2008, that problem got bigger and bigger, and here we are again. And now the problem is that what's different today from 2008 is back then you had the central banks of the world and sovereign treasuries of the world stepping in to save the system, to save the banking system. At this point, who's going to come in and say, and what they did was they blew up their balance sheets in the process. So now we have the same problem. And the question is, who's going to come in and save the central banks? Who's going to save the sovereign treasuries? There is no entity. And that's why I think you're seeing gold being purchased by these central banks and sovereign wealth funds, because they understand there's a huge problem. And the only way the only thing you can put on your balance sheet that'll explode upward in value when credit comes down is gold. And that's why you're seeing these, that's why you've seen, gold run from under 2,000 to over 3,000.
Yeah, and it doesn't seem to have, the momentum is just unrelenting. Do you see it slowing down from here? We do have a 100-to-1 gold to silver ratio. That's very rare. We've never been at a ratio, beyond 100-to-1 other than the big COVID crash in 2020. Right. Other than that, the ratio is at its peak right now. Do we see gold correct down to revert the mean of the ratio, or does silver catch up sooner or later?
Well, it wouldn't be surprising to see a $400 or $500 correction in gold. It's certainly due that type of correction at this point. But if you look at a chart, it really looks like a tractor in first gear that just steadily goes. Mm-hmm. The volatility, yes, it is finally picking up. And that tells me that since the volatility has picked up, we probably have bigger moves ahead of us, and they're going to be both upward and downward. But when this settles out, gold is going to be at a much, much higher number, and silver will be at a much higher number at a lower ratio, I think. I believe silver is going to way outperform gold. And it makes sense because the concentrated shorts are in the silver market, which is just a tiny fraction of the gold market. So it's so much easier to bully silver with paper contracts than it is gold. You put up less money, you get more bang for your buck. And over the years, they've tried to suppress silver because, and I've said this a million times, silver is the pin to gold's grenade. Mm-hmm. If silver blows up, let's say you start seeing $2, $3, $5, $8 or $10 days in silver. Do you really think gold is going to ignore that? No, gold's going to go wild to the upside also. And gold going wild to the upside is an absolute vote of no confidence.
Yeah. Well, you're starting to see copper also get a bid as well. To a lesser degree, platinum get a bid. So it seems like aside from the broad market, oil is also getting a bid. I'm looking at a $62 oil, WTI oil price. We did see some weakness now in the oil price last week. It seems to have rebounded this week from $56 to $62. Do we see more weakness in energy moving forward, or is there just too much risk out there, geopolitical risk to being priced in, like in the Iran war, Ukraine war, et cetera?
Yeah, you mentioned oil. Was it platinum or palladium and copper? Copper's come off its high, but mm-hmm. Palladium, platinum, oil. Those, if you look at charts, they're crushed. Those are 50% or less than their all-time highs. So those are not the bounces that you've seen in the last few days. And I think that's what they are, is bounces. And I think it's a reflection of fear of weaker real economies, in the future, 6 months, a year out. If the world economy was really humming along, you would certainly see at least $75 or $80 oil. And yeah, you're right. As far as from a geopolitical standpoint, oil, you could wake up one morning and find it up over $100 and never look back. If there were some type of geopolitical event that warranted that, a war or something like that. Then you'll see commodity prices explode.
Right. Now, what's been kind of the tailwind in the U.S. market, as well as the dollar, is that foreign investors pile into the U.S. market. And when they pull into the U.S. markets, what do they have to do? They have to go get dollars to buy U.S. stocks. That provides a tailwind for the dollar. That provides a tailwind for the U.S. stock market. Now, as things begin to unwind and reverse, are we anticipating the reverse of that? I.e., once the market unwinds further, you see a sell. You see no bid for the U.S. dollar, which is seemingly what happened as well. It seems like you look at the DXY, that's down. The euro is up, the yen is up, but that's simply because foreigners are fleeing the dollar. They're also fleeing T-bills, U.S. debt. Is this going to accelerate? Are we about to see a much lower DXY in the process as things unwind?
Yeah, I think there's a good chance that we see a much weaker dollar, and that would also be reflected in higher yields, because if you've got foreigners selling T-bills, notes, bonds, then yields won't go higher. But I mean, yeah, for years and years and years, for decades, the United States was considered a safe haven. And now I think foreigners are looking at the U.S. and saying, hey, wait a minute, their financials aren't that good. They're certainly not honest. You know, they say one thing, they make a deal, and they break the deal. I mean, the deals we've made, we don't keep our word. So I think the flight of capital out of the U.S. is going to continue and probably intensify. And I think gold has replaced treasuries as the intellectual or mental safe haven for foreigners. They're no longer flocking to treasuries; they're flocking to gold instead.
Yeah, that seems to be the case. I mean, what do you make of this trade war that we've seen with China? It seems like this entire thing was planned just to isolate China. You've now seen Trump raise the tariffs to 425% on the part of China. You've also seen him make threats towards any other country that if they don't cut off deals, if they cut off their deals with China, they'll be rewarded with less tariffs. Where do you think this ends? Are we heading into the old saying is when goods stop crossing borders, then bullets will. Is this where we're heading?
Yeah, I think ultimately that's where this is going to go. I mean, you have to look at Washington and think that they definitely want to get something started with Iran. I mean, obviously, Israel would like the United States to do something with Iran. I think that is the danger. That's the flashpoint. As far as the tariffs are concerned, you know, I went on the record right off the bat that I don't think tariffs are a great idea, because if nothing else, it will slow trade. And when trade slows down, then there's less income, less cash flow generated. And you can't shut cash flow off of a system that is full-blown Ponzi. And that's where we are. We're a full-blown Ponzi scheme. Yeah.
So let's think this through. The tariffs create kind of a bottleneck in the supply in the supplies on the supply side, which is inflationary. Right. But then you also have consumers who may just stop buying things if they get too expensive. So that's deflationary. Right. If foreigners stop buying our stocks and all of our other stuff, or dump dollars, that's another tailwind for inflation from the international side, meaning those dollars are coming back home to the U.S., which increases the money supply. So where are we heading? Seems like we've got multiple inflationary and deflationary forces in the works here. Is this kind of like the best word I can probably use, and correct me if I'm wrong, is probably stagflation or something like that?
Yeah, that's something I've talked about for quite a while, is that we would end up having inflation of the things you need and deflation of the things you already have. In other words, asset prices deflating while your cost of living inflates. And I mean, you're watching it in real time.
Wow. Well, I mean, have we ever had a scenario like this before?
You could say in the early 70s, leading up to the 73, 74 recession. I mean, inflation was heating up. The economy did go into a recession. Stock prices went down. Real estate prices were at best flat, but probably down. So yeah, we had like a mini bout of it back in the 70s. But it's not on. I mean, it's you can't say that it's unprecedented because I mean, if you look at the setup, it's exactly what you would expect at some point in time, where an unbacked currency weakens toward its true value, which is zero, and then asset prices that were bid up by massive amounts of credit start to weaken in price as credit becomes less and less available. So, I mean, the setup is there, and it is already happening, like I said, right before your very eyes.
Yeah. Well, I mean, it seems like we have one of two options, right? Do we either default on this huge debt or do we print our way out of it? Is it as simple as that?
Yeah, and I don't think there's any way that they're going to outright default. It goes back to what Richard Russell always said, inflate or die. So they're going to have to print. They're going to have to destroy the dollar in order to save markets.
Is that what they're going to do? Go ahead.
And it makes sense because at this point, because of the amount of debt outstanding, in order to create the ability or help the ability to service debt, they have to inflate. There's no way the debt as it stands right now can be paid back in current terms. It has to be paid back in cheaper dollars. And understand that Trump is a weak dollar guy. I mean, I think that's the basis of his thought process is the way to get out of this is a weaker dollar. And a weaker dollar, I mean, that goes back to Richard Russell's inflate or die. You have to weaken the dollar. You have to make the debt payable. And the only way to do that would be to wipe out debt, which they're not going to do because that's a default. So what they do is you get paid back in dollars that have less purchasing power.
Is that what they're going to do with this $6 trillion of debt to be rolled over in the next couple of months? Actually, we have $8 trillion by the end of to be rolled over, all of which is priced in at near 0% interest rate that needs to be refinanced at the 10-year level, 10-year yield level, which is at 4.4%. Do we? Right. How do they square the circle here? Is this where they begin monetizing the debt, or do they have another trick up their sleeve?
Well, they're going to have to, because I think over the next 3 years, I think the number is 28 trillion that they have to refinance. I mean, who's going to step up? Who's going to step up with 5, 10, 20 trillion dollars to refinance bonds? I mean, who in their right mind? Well, first off, who in their right mind put monies into treasuries at 1% or 1.5% or 2%, on a 5, 10, 20-year bond? Who did that in the first place, and who's going to do it again? I mean, first off, where's the money going to come from? Are the existing bondholders, are they going to roll over? I'm sure some will, but I'm sure it's not going to be a vast majority that do that. And the buyer of last resort for treasuries is the Federal Reserve. I mean, who else? Where else does that demand come from? It's gonna be on the Fed's shoulders to buy everything that does not get refinanced.
Could they deregulate on the part of Wall Street to incentivize them to pick up some of the slack as well, to buy more bonds? I'm sure there's a way, to roll back regulations and let banks lever themselves further, but it's already past midnight. Well, I mean, I think we've covered pretty much everything that's transpired over the last week or so. Anything else you want to talk about, Bill, before we wrap up here?
It seems like, I mean, I've been talking at the end of interviews, I've been talking an awful lot about the great taking, because understand, when institutions go down, the assets that you have with these institutions are not yours. They're legally the institution's funds. And when your broker or bank or whatever goes down, you're going to get bailed in. So you've got to act now before it happens. If you're 1 second too late, it's the rest of your life and the financial lifeline to your heirs, to your family going out, I don't know, 2, 3, 4 generations if your wealth gets wiped out. So
how can one mitigate this?
Well, you want to get out of the system. If you've got stocks and you absolutely know you want to hold the stocks, then have your broker issue the certificate. Once you have it in your hand, that is your title or your deed to the stock. It cannot get bailed in. You just want as few intermediaries between you and your capital. And I mean, the ultimate way to get out of the system is take balances, buy gold, buy silver, hold them yourselves or vault them in a private non-bank vault. If you put anything into a safe deposit box, you're going to find out that that's the worst thing you could do, because you'll never even get to open the box again once the bank, your bank or whatever goes under. So don't think of a safe deposit box as safe, because it's not. But you just basically want to get as much of your capital out of the system, where that if you wake up one morning and the markets are closed and brokers are failing and banks are failing left and right, that it doesn't affect you because you've already gotten your capital out of the system. The system is gonna gobble the public's. It's gonna gobble up the capital that they are custodian for. And that the laws are already on the books. They started putting these on the books since 2014. It's all over the world. And once this happens, you will have zero legal recourse to sue to get your capital back, because they follow the law, which allow them to bail in your money because the money's on their books in their name for your benefit. But the for your benefit part is not going to happen if your institution goes under.
Is there anything we can